Welcome to Earnings Recap. Today we're covering S&P Global's earnings report and earnings call January-March 2025. If you enjoy this kind of content, please like the video and subscribe to the channel. All right, let's dive straight into our deep dive on S&P Global's first quarter of 2025. We've gone through their latest earnings report, the earnings call highlights.
Yep.
And our goal today is really just to break down what matters, in plain English.
And it was quite a quarter for them. You really saw solid momentum in the core business, definitely some healthy margin improvements, a clear view on capital allocation, and then, of course, the really big news, that announcement about planning to separate mobility.
Yeah, that's a big one. Suggests a major strategic shift.
Absolutely.
So here's how we'll break it down. First part, we'll hit the key financial numbers from the report, revenue, profit, all that good stuff.
And the nuts and bolts.
Exactly. Then the second part, we'll get into the earnings call, what analysts asked, management's commentary, and their outlook. Sound good?
Let's do it. So starting with revenue, S&P Global pulled in $3.777 billion in Q1 2025.
Okay.
That's a solid 8% increase from the $3.491 billion they did same time last year.
8%. That's pretty strong growth.
It is. And what's interesting, underneath that is the subscription revenue grew 7%.
Right, that recurring base.
Exactly. That stability is, it's gold.
Totally. And if you slice up that revenue pie for Q1 subscriptions, that's half of it. 50%.
The biggest piece.
Yeah.
Yeah.
Then you've got non-subscription transaction revenue at 22%, non-transaction at 13%, asset-linked fees are 8%, recurring variable 4%, and then sales usage royalties just 3%. It really shows how, diversified the income streams are.
Right. You've got that solid subscription base, like you said, and then these other bits can add some real upside depending on the market and geographically. The U.S. is still the main engine, 62% in Q1.
Oh, dominant.
Yeah. Europe's significant, though, 23%. Asia's 10%, and then the rest of the world makes up the last 5%. That global spread helps them, ride out any regional bumps.
Okay, so what specifically drove that overall 8% growth? Because, S&P Global isn't just one thing, right?
Exactly. So if you look at market intelligence, growth came from their data analytics and insights area. That includes the impact from buying Visible Alpha.
Oh, okay.
Plus, familiar names like Ratings Express, Ratings Direct, their credit analytics tools, workflow solutions, they all chipped in. Although it was offset a bit because they sold off FinCentric.
So a bit of adding and subtracting there?
Yeah, exactly. Growth and some strategic pruning, you could say.
Gotcha. What about the other big divisions? Ratings, for instance.
Ratings had a good quarter. They saw a boost from structured finance, especially CLOs, collateralized loan obligations.
Okay.
More activity there. Also higher revenue from bank loan ratings, which probably links to more M&A happening.
That makes sense.
And U.S. public finance was up, too, just more issuance. Even their non-transaction stuff grew, things like annual fees, issuer credit ratings, particularly seeing strength from private markets.
Interesting. Commodity insights, always a hot topic.
Yeah, Commodity Insights just keeps benefiting from strong demand for their data and insights. Plus, they got a lift from conferences for a week, probably helped there.
Right.
And higher royalties from commodity exchanges. And that acquisition, World Hydrogen Leaders, seems to be contributing positively, too. Shows they're pushing into those newer energy areas.
And mobility, the one they're talking about spinning off.
Yep, that one. They saw new business growth in the dealer segment, strong underwriting in the financial segment, and finally, indices. Pretty straightforward there. Higher data subscriptions and more asset-linked fees because AUM and ETFs and mutual funds was up.
So it sounds like growth was pretty broad-based then.
Yeah, pretty much across the board. All the main engines were contributing.
Were there any, significant drags on that growth?
Well, they did call out foreign exchange rates. Unfavorable FX actually trimmed about 1 percentage point off that total revenue growth number.
Okay, so underlying growth was maybe even a touch stronger?
Potentially, yeah. Currency fluctuations just took a little off the top.
Okay. All right, let's shift to profitability. How did that 8% revenue growth flow down?
Pretty nicely, actually. Operating profit jumped 14% year over year, came in at $1.578 billion, up from $1.385 billion in Q1 last year.
14%. Wow. And the operating margin?
That improved too. Went from 40% up to 42%.
That's a solid improvement. 2 points. Shows efficiency gains.
Definitely. They're not just selling more, they're keeping more of each dollar sold, essentially.
And was that profit growth spread across the segments too?
It was. Market intelligence operating profit up 16%, ratings up 11%, commodity insights 13%, mobility had a really strong jump, 22%.
Wow.
And indices also up a healthy 16%. Yeah. So yeah, reinforces that broad strength we saw on the revenue side.
Now, were there any specific items hitting that operating profit number in the quarter? Seemed like a few charges mentioned.
Yes, good catch. There were a few things impacting the number. $33 million in employee severance charges, $12 million tied to the executive leadership team transition, $9 million for acquisition costs, $6 million for a lease impairment, and just $1 million for disposition costs.
So things to kind of mentally adjust for when looking at the core profit trend.
Exactly. Important context for the underlying performance.
And what about D&A, depreciation and amortization?
That was up just slightly, 2% to $293 million, mainly driven by higher amortization from intangibles, mostly related to that Visible Alpha deal we mentioned earlier.
Got it. Standard stuff post-acquisition. Okay, further down. Earnings per share, the bottom line number many focus on.
Right. Adjusted diluted EPS, that grew 9% year over year.
Healthy.
Yeah. And if you look at the unadjusted, the GAAP number, diluted EPS from net income was up even more, 12%, hit $3.54 compared to $3.16 last year.
So strong profit growth flowing through, plus maybe some help from buybacks.
Exactly. Which leads us nicely into capital allocation. How are they using their cash?
Right. What did the report say there?
Well, they returned over $900 million to shareholders just in Q1.
$900 million, that's significant.
Yeah, through dividends and share repurchases, it signals confidence in their cash flow and a commitment to shareholders.
Can you break that down a bit? The dividend and the buybacks?
Sure. So back in January, they boosted the quarterly dividend to 96 cents per share.
Okay, nice bump for income investors.
Definitely. And on the buyback front, they bought back 1.0 million shares for $650 million during Q1. That was under their existing 2022 program. And as of the end of March, they still had authorization for another 10.7 million shares under that program.
So plenty more capacity if they choose to use it.
Right. And they also kicked off an ASR, an accelerated share repurchase agreement.
Ah, yes. Tell me about that.
That started February 19th.
Yeah.
It's for $650 million total. They had 1 million shares delivered up front initially.
Okay.
And the whole thing is expected to settle, meaning the final share count and price are determined by the end of Q2 this year. It's just a faster way to execute a big chunk of buybacks.
Got it. So active on the return of capital front. Any other sort of interesting details tucked away in the report?
Yeah, a couple things. Private markets revenue, that continues to be a strong growth area for them. Up 21% year over year to $140 million.
21%. Wow. What's driving that?
Mostly debt and bank loan ratings in the private space, plus strength in their iLevel platform, which caters to private capital.
Okay.
Also, integration synergies from past deals, like IHS Markit, seem to be tracking well. They hit a run rate of $311 million annually. That's actually ahead of their target $350 million by 2026.
That's good news. Shows the deals are paying off faster than planned.
Yeah, always encouraging to see. And their vitality index, that measure of revenue from new products, stayed at or above their 10% target. Suggests ongoing innovation.
Good indicator.
And one last thing, an update on selling OST-TRA, their joint venture with CME. That's sale to KKR. Expected to close in the second half of this year. And they expect a pre-tax gain of about $220 million.
So a potential cash infusion coming later this year.
Roughly $140 million after tax, yeah. Nice little bonus.
Okay, that gives us a really good picture of the financials from the report. Now let's switch gears to the earnings call. This is where you get the context, the management thinking, the Q&A.
Exactly. And the absolute headline from the call was the formal confirmation. The board's approved, pursuing a full separation of the mobility segment.
Right, the spinoff. It's official now.
Yep. Tax-free spinoff to shareholders. It's a major strategic decision.
Huge. So what's the timeline they're looking at for this?
They're saying 12 to 18 months.
Okay, so not overnight.
No, definitely not. It depends on market conditions, getting regulatory approvals, all the usual caveats. But that's the target window.
And what's the main reason? The strategic thinking behind splitting off mobility?
It seems to be about focus. The idea is the remaining 4 divisions, market intelligence, ratings, commodity insights, and S&P Dow Jones indices, are more similar, serve similar customers. So keeping them together lets them share resources better, execute a more unified strategy, making S&P Global, the remaining company, more streamlined.
Okay, that makes sense for the RemainCo. What about mobility? How does becoming standalone help them?
Well, the argument is they'll be better positioned to chase their own growth opportunities, specific to the auto industry, without competing for capital or focus inside the larger S&P Global. More direct management, maybe attract investors who specifically want that automotive data play.
Right, tailored strategy. Can you give us a sense of the scale here? How big is mobility compared to the rest?
Sure. In 2024, Mobility did about $1.6 billion in revenue. Adjusted operating margin nearly 40%.
Pretty profitable business.
Oh, yeah. But the remaining four core businesses, together they did nearly $13 billion in revenue last year, with an adjusted operating margin around 50%.
Ah, okay. So Marinco is significantly larger and, on average, more profitable.
Exactly. That difference likely factored into the decision, I'd imagine.
And Mobility has some really strong brands under its umbrella, right?
Absolutely. You've got Carfax, which everyone knows.
Yeah.
Automotive Mastermind, Market Scan, Polk. Big names, backed by a ton of valuable data and tech specific to the auto world.
And Carfax itself has huge consumer reach.
Massive.
Yeah.
Their car care platform has over 46 million users. It leverages something like 35 billion vehicle history records.
Billion.
Wow. That scale is a serious competitive advantage. How that translates into growth for the standalone company will be interesting to watch.
Definitely. It was also interesting they highlighted Mobility's resilience during the call, despite some challenges in the auto sector overall.
Yeah, that's key. They pointed out over 70% of Mobility's revenue is tied to the used car market, which is generally less volatile than new cars.
Right.
And more than 80% of its revenue is subscription-based. So very predictable, recurring income. That's a big plus as it heads towards independence.
For sure. So what are the next steps in terms of communication around this separation?
They've scheduled an investor day, November 13th in New York.
Okay, mark the calendars.
Exactly. They expect to have made good progress by then, so they plan to give a refreshed view of the strategy for the remaining S&P Global, plus way more detail on the separation itself, capital structure, allocation plans for both companies, all that. That'll be the big reveal.
Good to know. Okay, moving beyond Mobility, what else came up on the call? Expense management was touched on in the report.
Yeah, they doubled down on that. Said they're actively managing costs, especially in the market-sensitive businesses, really trying to protect margins.
How are they doing that? What levers are they pulling?
They mentioned things like headcount and the pace of hiring, incentive comp, spending on third parties, professional services, the usual suspects.
Yeah.
But they also said they try to protect, essential embedded costs. It's about disciplined spending.
Got it. What about M&A? Any appetite for more big deals after IHS Markit?
They were pretty clear. No transformative M&A on the horizon.
Yeah.
The focus is organic growth, finding synergies within what they have. But they didn't completely shut the door. Said they'd still look at attractive tuck-in acquisitions, smaller deals that fit strategically with the core businesses if it creates shareholder value. So small, smart additions maybe, but no blockbusters expected.
Makes sense. Now, free cash flow guidance was tweaked down slightly. Why was that?
That's right, a slight reduction. They said it was mainly down to timing. Timing of tax payments and some working capital movements. Not, they emphasized, due to weaker underlying performance or cash generation.
Just timing. Okay. And how about their guidance philosophy for the different divisions going forward?
Well, they specifically adjusted guidance down a bit for ratings and indices revenue.
Why?
Because they saw issuance volumes pull back in April, and they expect that to hit Q2 transaction revenue of those areas.
Okay, reflecting current market conditions.
Exactly. For the other divisions, Market Intelligence, Commodity Insights, Mobility Ability, they kept the guidance the same. Reflects, sort of, a neutral outlook based on the range of possibilities they see right now. Cautious, perhaps?
And there was a question about Commodity Insights and energy prices, right? How linked are they?
Yeah, good question. Management clarified their revenue there is mostly driven by licenses and subscriptions for their price data, not directly by the daily ups and downs of oil or gas prices.
So it's more insulated.
Right. And they added that their current guidance already assumes oil prices in the low 70s for the year anyway, so they're comfortable with where things are. Again, highlights the benefit of that subscription model.
And lastly, they mentioned the new Chief Client Officer role. Any early reads on that?
Still early days, they said, but initial feedback is positive. Seems like the engagement with clients under this new structure is encouraging. Too soon to quantify the impact, but they sounded optimistic about that increased client focus.
Okay, well, that pretty much covers the key points from both the report and the call.
Yeah, I think so. To wrap it up, S&P Global started 2025 strong. Solid financials, good growth across the board. They're managing costs, returning capital.
And the big headline.
The big headline. Definitely the plan to separate Mobility. A major strategic shift they believe unlocks value for both sides.
Right. So here's a final thought for you, the listener, to consider. What are the ripple effects of this kind of major strategic split? Think about S&P Global separating out a big established unit like mobility. How could that change the game in financial information and in the automotive data world? What new opportunities or maybe challenges pop up for these two separate companies as they go their own ways?
It's definitely something with potentially big implications down the road. And as always, if you want the full granular detail, check out the complete earnings report, listen to the full earnings call replay. Lots more context directly from management there.